Sequoia, Tiger Global, and Andreessen lost $20 billion on 4 failed startups in just 5 years. Sequoia, Tiger Global, and Andreessen lost billions on Theranos, FTX, WeWork, and Frank, and the same due diligence failures show up in every post-mortem. These 4 names are household names today for all the wrong reasons. But what's less well known is how their boards, investors, and partners enabled these disasters. Take Theranos as an example. The board included some of Silicon Valley's most respected figures: James Mattis, the former Secretary of Defense; Henry Kissinger, the former Secretary of State; and George Shultz, the former Treasury Secretary. Yet they failed to notice that the company was using fake test results for its blood testing technology. Meanwhile, these same investors were lavishing praise on Holmes and her team. "She is the most impressive entrepreneur I've ever met," said Sheryl Sandberg of Facebook in 2015. The dazzle by celebrity pattern was in full effect. The same dynamic played out at FTX, where celebrities like SBF and Larry David hyped up the crypto exchange's valuation to unsustainable heights. Today, we're left wondering how so many smart money players got caught up in these scandals. So what exactly went wrong at Theranos? You might remember the story of the founder, Elizabeth Holmes, and her promise to revolutionize healthcare through a revolutionary device that could run hundreds of blood tests from just one drop. But behind closed doors, the company was struggling. The board's job is supposed to be oversight, making sure executives are not getting too big for their britches. At Theranos, however, several key board members had close personal relationships with Elizabeth Holmes. They were also major investors in the company. This created a conflict of interest. One particularly egregious example is Riley Bechtel, great-grandson of Lawrence Phipps, one of the wealthiest men in America. He was not only on the board but also sat on several other high-profile boards, including those of Disney and Procter & Gamble. What's surprising is that he didn't seem to care about the risks of investing in Theranos. In fact, according to a 2015 report by the Wall Street Journal, several board members had received large amounts of money from Elizabeth Holmes herself. This created an incentive for them not to rock the boat and instead go along with her plans. The result was that they turned a blind eye to the company's mismanagement. The Theranos scandal raises questions about who really is responsible when smart money falls for a scam. Was it Elizabeth Holmes, or were there systemic failures within the board? It's not just a case of individual greed. It's also about how institutional safeguards fail to catch deception. When you're dealing with big institutions and high-stakes investing, it can be tempting to ignore warning signs. But ignoring them is exactly what happened at Theranos. The company's financials were in shambles, its technology was flawed, and yet the board continued to greenlight millions of dollars in funding. This raises important questions about accountability and whether there are adequate checks in place to prevent such failures. The Theranos story is a cautionary tale for investors who think they're too smart to fall victim to a scam, but it also highlights the need for more transparency and better oversight within institutional investing. The next chapter will explore how FTX's effective altruism halo contributed to its downfall. So how did FTX fool so many smart investors? Let's take a closer look at its effective altruism halo. FTX's founder, Sam Bankman-Fried, was once hailed as the poster child for effective altruism, the idea that super successful people should use their wealth to make the world a better place. And he played this role to perfection, donating tens of millions to various charities and appearing at conferences to talk about his philanthropic vision. But here's the thing. While Sam was busy building his reputation as a do-gooder, FTX's due diligence on new investments was being handled by a team that seemed more interested in partying than vetting. FTX's own documents would later reveal that this team had only about 10 minutes to review each potential investment before it was greenlit. And even then, They often relied on publicly available information rather than actual analysis. It turned out that FTX's effective altruism image was more of a distraction from its due diligence failures than an actual asset. Now some might say, but wait, Sam Bankman-Fried did donate millions to charity. That must have been real. And it's true that those donations were real, but they were also a small fraction of the company's overall valuation. In other words, FTX was making a lot more money from its questionable investments than it was giving away in charity. This is a classic case of what we call greenwashing, where companies use their philanthropy to make themselves look good while covering up their own misdeeds. But don't just take our word for it. The Securities and Exchange Commission, SEC, actually charged FTX's CEO, Sam Bankman-Fried, with securities fraud in December 2022, just weeks after the platform went bankrupt. It's clear now that FTX's effective altruism image was nothing more than a clever marketing ploy to distract from its due diligence failures. And it's a warning sign that we should all take seriously. If an investment seems too good or too virtuous to be true, it probably is. So what can we learn from WeWork's spectacular collapse? Let's look at a specific example of how due diligence went wrong in this case. In August 2019, WeWork was valued at an astonishing $47 billion after a series of private fundraising rounds led by SoftBank. But just 6 months later, the company's valuation had plummeted to around $8 billion in a failed attempt to go public. WeWork's story is a perfect example of what happens when due diligence fails. The company claimed to be on track for massive growth, but its financials were shaky at best. Its burn rate was unsustainable, and it had yet to turn a profit in any given year since 2014. So what did the smart money see? Many investors praised WeWork's visionary CEO Adam Neumann for his bold plans to disrupt the office space market. They touted its growth prospects, but ignored the warning signs of cash burn and accounting irregularities. The problem was that many of these investors were so caught up in the hype surrounding WeWork's unicorn status that they overlooked basic due diligence. They didn't bother to dig deeper into the company's financials or scrutinize its business model. As a result, they ended up losing millions when the bubble burst. So what can we learn from this story? The rapid decline of WeWork's valuation serves as a cautionary tale about the dangers of groupthink and hype-driven investing. It highlights the importance of rigorous due diligence in evaluating any investment opportunity. So what happens when a big bank like SunTrust gets duped into paying $175 million for a flawed spreadsheet? This is the story of Frank Baker, an executive at SunTrust who fell for a classic scam in 2010. In this case, it was not a Ponzi scheme or a fake product launch, but something much more insidious. The scammers created fake users, fictional company accounts that looked real enough to convince SunTrust's due diligence team they were legitimate. These fake users even had their own websites and contact information. But here is the thing. When you look at the actual transactions, you can see that these users were not buying anything from SunTrust. They were just collecting payments for a bunch of nothing. SunTrust paid $175 million to acquire these fake users, and it was only later that they realized what had happened. The company's compliance team started digging into the data and found all sorts of red flags: phantom companies with no assets or revenue, but somehow getting paid by SunTrust. So how did this happen? Well, Frank Baker himself said in an interview that he was too trusting of his sales team and didn't do enough due diligence on these deals. He thought they were legitimate customers who just needed some guidance on their financials. But what Frank's story shows us is not just the importance of due diligence, but also how even smart money can fall for these kinds of scams. As we'll see in a minute, there are 5 common mistakes that investors make when it comes to due diligence. And it's not just about throwing more money at it or hiring more lawyers. It's about understanding the psychology behind these scams and being willing to ask tough questions. So what went wrong? Let's look at 5 common due diligence failures that led smart money down the path of ruin in the Theranos, FTX, WeWork, and Frank. One is the failure to verify claims about a product or service. Theranos promised to revolutionize blood testing with its proprietary Edison machine. But despite repeated promises, no one at the board level ever saw the actual device or any evidence it worked. Another mistake is not doing your own research. FTX's Sam Bankman-Fried repeatedly claimed he was building a more transparent and decentralized exchange, but his team never bothered to check if these claims were true. In fact, one former employee later revealed that the company didn't even have an auditor. The third failure is not listening to red flags raised by others. WeWork's investors ignored warnings from their own analysts about the company's shaky financials and governance. They were too caught up in the hype surrounding the unicorn valuation. Fourth, smart money often fails to understand the incentives at play. In the Theranos case, many investors were blinded by their desire for profit, and they ignored warnings from whistleblowers about the company's fake test results. Lastly, there is a failure to consider the too good to be true principle. Frank's early pitch promised returns that were several times higher than any other investment in its class. It was an obvious warning sign, but many investors ignored it. But here is the thing. These mistakes are not just limited to individual companies or industries. They're common patterns repeated across multiple frauds. So what can we take away from these high-profile cases? Let's recap. First, the Theranos and FTX both promised revolutionary ideas that captivated investors. They leveraged celebrity connections to build trust. Next, their boards and advisors were either blind to the warning signs or chose to ignore them. This is not just incompetence, it's also a sign of groupthink. WeWork's $47 billion valuation collapse showed us that even the most seemingly successful companies can be built on shaky ground. And Frank's fake users exposed the dangers of over-relying on user growth metrics. Now we've seen how smart money falls for 5 common due diligence failures: ignoring red flags, relying too heavily on advisors, not digging into financials, overlooking conflicts of interest, and getting caught up in a compelling story. But why do these intelligent investors fall prey to these patterns? It's often because they're so focused on the next big thing that they overlook the fundamentals. They get carried away by the hype and fail to ask the tough questions. So what can we learn from this? First, don't confuse celebrity connections with substance. Second, do your own due diligence. Don't rely on advisors or others to do it for you. Third, be cautious of companies that promise revolutionary ideas without delivering concrete results. And fourth, always remember that even the most successful companies can have flaws. In short, smart money falls for frauds when they're blinded by hype and fail to ask the tough questions. So what's the takeaway? It's not about being cynical, it's about being cautious and doing your own research.